Good evening. Welcome again to Face to Face. Talking now to Jim Sinclair, who is in gold. He's part of an exploration company, Tanzanian gold exploration, and he's taken a bet, offered $1 million bet on what the gold price will be. Jim, that's a way of getting the attention. What was the bet?
I think it was out of frustration that I offered that wager. But I've wagered a great deal in my life. I mean, it's very much a part of my background. And the bet was that gold would reach $1,650 an ounce by January the 14th, 2011.
When did you offer that wager?
About 2 years ago.
So where are you sitting now in terms of the wager?
Well, I'm firmly entrenched in my belief on the price and the day. The only taker I got on the wager was actually a hedge fund out of Toronto, who wanted me to enter into what's called a one-touch put, which is an over-the-counter derivative. And if there's anyone on the face of the earth that can't find themselves in an over-the-counter derivative, it's a person who for 10 years has been screaming and they're going to kill us all. So I really didn't get a taker that could prove, in fact, that they could pay. And, you know, anybody will take a wager if they have nothing to lose. But a wager to be valid needs to be in the U.S. concluded in Nevada, the only state that allows a wager, and has to be proved on the other side to be able to function. But nobody came up that was able to function.
Well, let's go behind that. Why you would be prepared to offer such a wager?
Well, I have a firm belief that the price of gold is tied directly to the U.S. dollar and the inverse. And
you're not the only person to say that.
No, so I think it's common. I think it's a very firm belief. But at the same time, the amount of difficulty that exists in the world economies that hasn't really been addressed yet is very dollar negative. And there's levels of 82, which has been broken, 72, 62. Below 72, you key in an inflation that most people don't understand or can't conceive of. One caused not by an economic event, but rather by a currency event. And there are many periods in history that you can study that will bear up that feeling. Now, as far as being able to determine a price and time, there's a very fine article written called It's Only Time by Martin Armstrong. And that article goes into the mathematics and the historical, cyclical characteristics that allow you to come to a conclusion like I did. It's not happenstance, it's not technical analysis, it's solid historical precedent that the price will maximize between between January of 2011 and June of 2011.
Let's just stop there for a moment and look at what's happened since you offered that 2 years ago.
Yes.
The subprime crisis, the huge injection of funds and potential funds into the system with the potential for inflation down the line, which is friendly to gold.
Yes.
So, in fact, conditions have improved for your wager.
Well, not conditions you'd want to see improve.
But they have.
But they have. And I'm going to say today, which I haven't said publicly, but I believe that November 4th to November 7th, or 120 some odd days from now, you'll probably have reached a situation in which confidence in the currency is brought into serious question. There are very big challenges coming up. And the money that's been put into the system, the $12 trillion that's gone into the U.S. so far, not including anywhere else, even today you can see on the wires services where AIG is concerned, has done nothing whatsoever. The money came in the front door, paid off the over-the-counter derivative, and went out the back door. AIG is now considered by Citibank, that's a good one to consider it, to be worthless, even with all this funds, the trillions that have gone into it. So this has not gone into a destruction of money. This money is in a system, active in a system. And that's what's threatening the value of the U.S. dollar. So the biggest fight right now is for the U.S. to be able to finance this huge deficit and do everything possible not to let the dollar decline here.
We've just had Joseph Stiglitz in this country talking about inflation targeting and what's being stored up. In South Africa, we're also very emotional about gold. This city that we're in was built on gold. At the end of every radio news bulletin, you have the gold price. I'm not sure how many countries have that. And we tend to veer. There's a fashion in favor of gold against gold. Maybe it goes with the economic cycle.
I think that the fashion is currency. Gold is a currency. Gold is not a commodity. When you dig it out of the ground, you tend to value gold by what it costs you to get it out. So most of the mines are more attached to cost than they are to recognizing that gold is a currency and has functioned magnificently as a currency. When it was at $248, it was perfect because you had a 21-year bull market in the US dollar. So gold is not something that falls into fashion and out of fashion as much as it functions perfectly as a currency and should be viewed as a currency. Jewelry demand for gold is more the Asian wives wearing their husband's bank.
Implicit in what you say is that we have one exchange-traded fund in South Africa which enables you to buy, in effect, the gold price as opposed to gold shares. What you're saying is buy the gold price, not the shares.
Well, the safest one, and I mean, I'm a CEO of a public company associated with gold, and I'm going to tell you that the safest clearly is gold itself. I mean, that's a given because there's nobody between you and your gold. There's no need to raise money. Now, here in South Africa, you have an exchange-traded fund which you tell me and clearly tied to the gold and has the gold. But if you would read the prospecti on the other exchange-traded funds, the biggest ones, the ones that are the size of central banks, you'd find out that they don't have to have the physical gold. They're very clear. They leave nothing to the imagination. They do not have to own atomic element 79 or whatever.
But you're saying that that's what you do need to own.
Well, I mean, we do need to, in the sense that if you're holding a currency that has a high potential of becoming less value, you at least want to maintain buying power. And what has gold always done? Gold has always maintained buying power throughout the hundreds of years. Gold will buy the same amount of goods today as it would have bought in the 1920s.
There's a wonderful table which shows the price of gold in real terms back to the 1200s, which is an interesting thing to explore.
You can't get this out of people's minds. Yeah. Whenever politicians screw everything up, people will turn to a currency that has no liability and no nationality.
What happens when it becomes more expensive to mine? It's very expensive in South Africa at the moment. You get to a point where no one's going to be mining it anymore. Maybe 100 years, maybe 200 years, and then there must be a finite amount of gold.
Well, you're going down on mine supply as it is now. There's two parts to that. Of course, as the price of gold goes up, lower grades can be mined, and therefore your resources or reserves will increase. But the overall amount of gold that has been mined is declining around the world, while the amount of gold that's being utilized as currency and investment is growing exponentially.
It's also been said that all the gold ever mined is still there. It might, some of it be at the bottom of the sea, but it all still exists.
We send a little bit into space, but I'm sure an enterprising entrepreneur will go into space and bring it back.
You talked about a $1,650 in 2011. What about 2015, 2020?
We have to see how we fare through 2012 because of the challenges we have. I don't think gold's coming down this time. I mean, our original conversation. I think gold will find its way back into a system, but not in the sense of convertibility. And it probably will be tied to an international basket of currencies, the SDR that's being talked about now by the IMF. It will be somewhat like it used to be, except what it will be is a simple alarm attached to international liquidity, not convertibility. But whatever the price is, when that system is first put in place, will become a fulcrum point around which gold will trade according to the rise and fall in whatever index they create of international liquidity. So this is discussed quietly amongst people who are at power, at cause in monetary affairs.
In summary, would you go for Krugerrands? Would you go for an exchange-traded fund? Would you look for the right gold company?
There are first and foremost gold in my hand. All right?
That's Krugerrands.
That's a Krugerrand. Secondly, a company that could provide significant leverage in terms of what they're doing in the ground, financing, capacity and management, and of course significance in the geology and all of the criteria for their asset. If you can't do that, then your alternative, much better than what's traded on the New York Stock Exchange or in London, is the character of the exchange traded fund here, where you can be assured that you in fact own the gold.
That's right. Well, that's a good place to stop. That is Jim Sinclair, and if you want to watch this interview again, it might be worth your while. Do so on summit.co.za, also on the related websites, on Financial Mail's website, and on Business Times and Business Day and Fin24.